Portfolio Builder members, we are live. We're going to review the two portfolios and what our expectations are for future trade alerts. Let's start off by reviewing the high risk portfolio allocation. Currently, each unit of investment in the high risk portfolio is long UVXY with 42 shares, which is coming in at 4.5% of the portfolio. We have 98 shares of TMF. This is 3 times the TLT product, representing 24% of the portfolio. That's our defensive positions, typically something that make money in a crash. Now, of course, if the crash is caused by the bond market crashing, then we'd only expect most likely UVXY to be going up. And then funny enough, one of our offensive plays, the oil play. On the offensive side, we have 17 shares of Coin. Coinbase is now suing the SEC for not giving response to their requests on regulatory framework. And at the same time, the SEC has served a Wells notice to Coinbase. Now, it's funny that, of course, the SEC allowed Coinbase to publicly list, and now they're coming back and saying that they're holding securities illegally. So why did they accept them in the first place? Very muddled regulatory issues happening currently in the digital currency space. That's coming in at 26% of our portfolio. We've seen Coinbase jumping up and down over the last month, but still one of our favorite plays and extremely undervalued long-term, as it's really shaping up to be the primary US digital currency broker. Next, we have FNGU. This is our best performing asset in the portfolio this year. This has been led much higher, probably by AI and great earnings. In fact, only about 5 companies have delivered all the gains in the S&P 500 this year, and every single one of those are held in FNGU, leveraged times 3. So we have 14 shares of FNGU representing 33.91% of the portfolio. Our inflation hedge, which we will want to double down on soon, is NRGU. This is the big US oil and gas companies times 3, and it's currently coming in at 10% of the portfolio. Now, again, we're going to be waiting for the Fed to pause. So this Wednesday, we have the FOMC meeting where they're going to likely raise interest rates by 25 basis points. And we do have one of the big banks failing again today, which is probably why we've got digital currencies having a nice jump, but we're still pretty confident there will be a 25 basis point rate hike, and then we're going to need the next 2 CPI prints to come in weak to finally get the pause in June. So we'll have 2 CPI prints before the June interest rate decision, and so that's really what I believe is the only data that matters. Of course, all the other data will help us predict the CPI, but that's really what we're focused on in the next 60 days. So to be clear, this Wednesday, no webinar. I'm going to be studying Jerome Powell and the FOMC. The next week, we will return. We don't really see any reason to make major adjustments to this portfolio until we've had at least 1 more CPI print come in, and probably 2. If they're going to pause, we're going to bet that inflation is going to come back, and we need to double down on NRGU and likely trim off our TMF, Coin, and FNGU, and maybe even add a little bit to UVXY. This portfolio has had a bit of a pullback this month, down 10%, still returning 16.91% for the year. And again, that's been mainly from a pullback in Coinbase due to the Wells notice served by the SEC, which again, we think they're going to work out with without a lot of complications. Maybe pay some fines and then get some more certainty on regulatory framework. Safe growth portfolio allocation. This portfolio, we are much heavier in bonds, and we're much more heavier in the inflation hedge. So we're playing 2 assets that are down dramatically. And then we have some growth plays with emerging markets, GBTC, Bitcoin, and then a small inflation hedge. And the reason why we have a small stock crash and hedge with UVXY. The reason why we don't need a massive UVXY position in this portfolio is because of that gigantic treasury position. Currently, in the safe growth portfolio, we have 19 shares of UVXY representing 3.38% of the portfolio. We have 114 shares of TMF, that's the TLT times 3, representing almost half the portfolio at 46.71%. On the offensive side, We have EDC, that's the ticker EEM times 3, or emerging markets. This had started off really good a few months ago and has kind of pulled back due to rising interest rates and the dollar coming back up. But long term, we do think emerging markets can outperform US markets in this cycle because we believe inflation's falling, the dollar's falling, and interest rates are falling. And so currently that's 12 shares of EDC, representing 15.7% of the portfolio. We've got 22 shares of GBTC. This has been one of the best performing tickers in the market outside of FNGU, coming in at 16%. And then we have a larger inflation hedge already in place with 18% long NRGO, still one share. So in this portfolio, we're pretty well set up. And once the pause happens, we might simply get a little more bullish on the EDC, GBTC, NRGU tickers and shave off a little of TMF to cover that. So that's what we're seeing for that portfolio coming up next. This portfolio is down 2% for the month and up 5.69% for the year. It's really making a big bet on bonds, though. We really haven't had the bonds pay off. Bonds have had the worst crash in decades and are coming out of an 18-month bear market. So we still see that potentially being one of the best performing assets over the next 12 to 24 months as growth slows down, stimulus slows down, inflation falls, and interest rates fall. Okay, so let's look at some charts and data. This is really the big argument in the market. Is labor driving sticky inflation long term because we've had these rising wages, and it's showing up in core services. So you can see core goods are back to target 2% inflation, but core services and labor wage increases remain elevated, way too high, above 6%. This is a look at the breakdown of the US core CPI, and one thing we do want to note is the shelter component, the green component, is using old data that's been falling significantly for the last 12 months. So far, the green data, as you can see, has only got larger and larger and larger, but we should be very close to the point in time where that green portion of the CPI is going to fall for about 12 months. So that's going to be very good for getting that inflation down. Now, if you exclude food and energy, the core is still very high, and the headline has only dipped below 5. So we can still see the inflation still very high, but it has been falling for quite some time, and we believe that's going to continue. Let's look at wage growth, and you can see while it did peak back in July of last year, it's also been falling consistently to date. So we do believe, again, that inflation is set to fall. And that this is about a 12-month falling inflation prediction. It's looking at the money supply, and then it's comparing CPI, which is the consumer price index, the PPI, the producer price index. And again, it's been good at predicting that both of those would fall if you drag it 16 months into the future. So currently, we have just over a year of falling inflation based on this metric. And in fact, with all the bank collapses in the last month, as well as quantitative tightening, we have one of the biggest drops in the money supply in history just in the last month. So we do believe inflation is set to fall. Now in Europe, they've had some surprises to the upside in inflation, as well as Japan, especially in the UK. But overall, if we lead the EU's in overall inflation behind Spain's by 3 months, it's predicted falling inflation. And then we could perhaps be looking at 3% inflation in the UK in about 3 months from today. And that would be very bullish for bond markets. Now, again, food has been a very expensive component, especially in the UK data. And if we look at fertilizer prices relative to the CPI, you can see they haven't dropped the prices on food, but the cost to produce food has gone back to normal. And so, again, we're seeing this in a lot of companies. They've got their consumer used to paying these higher prices and they don't want to give up those profit margins. So this has been making the inflation stickier. One other important thing to keep in mind is the US has drained about 350 of its 700 million total strategic petroleum reserve. This has really helped keep the inflation down. And they've continued to draw on it, even though they said they're about to refill it. So what's going to happen if they do try to refill it to the inflation picture? So we're keeping a close eye on oil. So far, no big jumps in oil to be overly alarmed about. Another part of the inflation picture will be China pumping credit into its economy. Now, while China reopening does have a lot of deflationary aspects to it in terms of getting more goods and services for cheaper to the world, if they are pumping money into their economy, they're going to drive up commodity costs. That's something we got to be alarmed of. And so they absolutely are pumping money into the real estate markets, and they're looking at how to get more stimulus into the consumer side of the economy. And we know how that worked well in the US was just to give out free money to everyone. So we want to keep an eye on China's credit growth, but it typically, again, leads by about 7 to 8 quarters. So this is still showing that we have with the Chinese credit cycle about till the end of this year and early into next year before that's going to start putting a lot of pressure on commodities and inflation. So that's what we're looking at on the Chinese side. This is just showing you the willingness of the Federal Reserve to print money when the banking system's at risk. And again, we have another bank that the big banks gave $40 billion to. It looks like they're going to have to lose that because they're short another $60 billion and nobody wants to pitch this in. Now, with the Treasury general account almost empty and the debt ceiling debacle coming up, it doesn't look like this bank's going to get bailed out. Another reminder, there's $5 trillion in money markets earning a high interest rate. But soon as the Fed starts to pause and drop interest rates, that's going to shove money out of money market funds into stocks, commodities, bonds, and one of our favorite assets, cryptocurrencies. So this is a huge, huge catalyst that's waiting to be sparked. And the only thing holding them back is falling inflation, which we're quite confident is going to begin to occur dramatically in the next 3 to 6 months. Here's the First Republic Bank, which was supposedly going to get bailed out. Big banks chipped in 30 billion, not 40, my mistake, to bail it out. But they're still short another 70, and it looks like it's going to fail. Now, at some point, one of the big banks might buy it out. But for now, everybody is standing back watching the collapse occur, down 51% in the last 5 days. Here's the 2-year Treasury, which again is very predictive of interest rates in the future. And now it's 100 basis points below the current federal funds rate. If they do increase federal funds rate to 5 to 5.25 this coming Wednesday, then it's going to be 125 basis points above the 2-year Treasury. This is indicating that we're very likely to doing one more rate hike maximum and then pausing. Typically, you have a 12-month stock market rally after the Fed pauses interest rates. Here's Coinbase going as high as over 80 and then really bouncing around in the 50 to 70 range over the last several months. We do believe this can go back to new highs long term. This is one of our favorite high-risk growth picks. At some point, we could potentially consider going back to ETHE, but there's still a lot of drama going on with the Grayscale Trust, and we've only kept a Grayscale product in our Safe Growth program with GBTC. Here's FNGU. Again, this is playing the big tech companies that have given the entire stock market its returns. It's up 97% year to date, and we do believe it can go much, much higher, especially with them releasing all these AI products that are extremely impressive. And the implications of what they're going to do for the economy are just being figured out now, as they're only weeks old. Treasury market has been pretty much flat this year. We've got a big bet in both portfolios, a huge bet in the safe growth. And long term, we're extremely confident interest rates must go back towards zero for governments worldwide to continue to grow debt. So this has extreme gains ahead, and we do plan to hold these positions for much longer. Currently up 8.5% year to date. NRGU, the oil play, we waited quite a while to get into, and we've now gone long. This is down 17% year to date. Soon as the inflation cycle comes back in, which is likely mid to late next year when it peaks out, we do think NRGU could at least double from here. So we plan to slowly build into this as soon as we think the inflation is going to start to become a problem once again. Price of oil not showing any signs of inflationary issues currently, down 6% year to date. Been trading in a $72 to $88 range. UVXY, the crash hedge, has been a dud with almost no potential profits ever over the last so far this year. We had one big bounce in February where it doubled or nearly doubled, but since then it's just been getting crushed, and we haven't really touched this product too much in nearly a year. We've barely added to it. Again, once we think the inflation is going to become a problem dramatically, that's when we'd want to really get heavy on that product. And again, we think that might be a year out. EDC plays emerging markets ×3. Started off really strong. You can see jumping to 40 to start out the year. But then we had rising interest rates and a rising dollar and a new scare of inflation coming back, and it crushed it back down to 30. This cycle, for 12 to 24 months, we do think EDC could outperform UPRO, which would be emerging markets versus SPY. Here's GBTC kicking some butt, keeping up with FNGU, up 96% year to date. Looks like the parent company of Grayscale Trust may miss one of its debt payments in May and cause a lot of chaos. So while we don't mind the position in the safe growth because it's trading at a discount compared to the assets the trust holds, in the high risk portfolio where we're willing to put a bigger bet, we're still sticking with Coinbase until there's more clarity on what's happening in this space. DXY has been, again, you can see what crushed emerging markets there. It was the dollar rising from January to February. But this has been trading in the range between 100 and 105. And it's likely going to stay there until the Fed signals are going to pause and stop quantitative tightening. Then we could see the dollar fall to the $90 range. And that's when I think you're going to see some new highs in cryptocurrencies. So we're still very excited to time that, which again, I think it's going to be about a 12 to 24 month cycle where the dollar falls to that level. Now, notably, Stanley Druckenmiller came out saying his only high conviction trade today, the dollar is going to fall in value. So that's hit a lot of headlines. Now, interesting with this bank falling so much today, I'll pull it back up. The First Republic Bank down 51%. We can see that the index product, KRE, the regional banking ETF, was not down much today at all. In fact, it was up at the same time as that being down. So we're not seeing systemic risk in regional banks. Just a few banks are really collapsing right now. Also, if we look at the KRE to the 2008 crash, we're nowhere near those levels. But still, it's been a very violent crash over the last year for the regional banking sector. And here's a shorter term look at it in the past month, down 8% in the last month. If we look at copper futures for inflationary signs coming out of China, there's this big hype about China reopening. One of their biggest commodities they use is copper, and overall it's fallen year to date from a $4.25 level to $3.87. So if we see copper starting to take off again, that'll tell us China is really heating up and could cause some inflationary pressures in the commodity sectors and metal sectors. Now, gold has gone up year to date about 9.5%. If we use the copper to gold ratio, interest rates should really be falling quite dramatically. And so far they're flat. So we still think interest rates have a long ways to go down from here based on M2 money supply, and then again, copper to gold ratio. And again, here's a look at TMF one more time. It should be up dramatically with copper falling this much and gold going up this much, but yet interest rates remain flat. And this is primarily due to services and labor inflation remaining sticky and some bad prints coming out of the UK, Japan of rising inflation. Okay, that's a wrap for today's update. Let's go ahead and take any questions. But again, I anticipate no changes next week. And we're going to be taking next Wednesday off because the FOMC minutes come out, the interest rate decision comes out, and then Jerome Powell's speech comes out at the time we typically run our webinar, which is when I want to be watching that very closely. The Fed's balance sheet is back to doing the $60 billion a month of quantitative tightening. They haven't increased it since that last big print. Kat asked that question about the Fed's balance sheet. Okay, very good, guys. So we will keep an update out next Wednesday. No trade alert unless something dramatically happens. And we're really just focusing on the next two CPI prints. So we'll have one in May and then one in June before the June meeting. If both come in very cool, falling inflation, we might make some adjustments after we see the next FOMC minutes. Thank you guys so much. And if you're in Rebel Dividends, we'll see you back on Tuesday. And then again, we'll just do an email update next week for Portfolio Builder members so I can focus on that Fed meeting.